if you think about the problem of like how to do data backups, if you don't provide a good decentralization friendly way of doing backups, then either your users are going to constantly lose all their data, or like things will drift toward a centralized solution, and then they're not actually getting the benefits. Basically, not just thinking about the decentralization properties of the thing itself, but also thinking about the decentralization, fairness, market concentration properties of the game that is being created by the protocol. And like this applies to Ethereum itself, right? Ethereum needs to think about staking. Ethereum needs to think about like DEXs and different types of transaction sending economics. It applies to applications on top of it. It applies to every layer.
The crypto world feels like it's holding its breath. Prices fluctuate, regulations loom, and the promise of a decentralized future faces real-world challenges. The dream was simple: a decentralized financial system owned by no one, available to everyone, where trust doesn't rely on governments or banks. And for a while, it felt possible. Blockchains were booming, smart contracts were exploding, and people were building faster than regulators could react. But now, that dream is under stress. Fees are rising, networks are congested. Decentralization is becoming a buzzword rather than a practical principle. Users are growing impatient, developers are losing faith, and capital is looking elsewhere. The cracks that were once whispered about in crypto circles are now flashing like warning lights. And here's the scary part. The system doesn't just have one problem. It has multiple sources, and they're coming from different directions simultaneously. What happens next won't be decided solely by price. It'll come down to execution, narrative, and who's able to evolve when it matters most. In a public community talk, Ethereum co-founder Vitalik Buterin said the quiet part out loud. Ethereum must do better. Cannot do better. Must. Now Vitalik is worried. Fees are still too high. Speeds are still too slow. And decentralization, the heart of Ethereum, is slipping. Developers are frustrated. Users are leaving. And competitors like Solana and others are gaining ground. Ethereum was supposed to be the foundation of a new digital economy. Still, now, even its founder says time is running out. If Ethereum doesn't evolve now, its dream of being the world's decentralized computer may vanish. And so might the future of crypto innovation with it. Let's watch clips from Vitalik's explosive session to gain more insight on Ethereum. Please don't forget to like, subscribe, and enable notifications for more in-depth content. Thanks for joining us again. Enjoy the rest of the video.
Basically, level 1, we're decentralized because we have the top decentralization KOLs as advisors. Level 2, we're decentralized because we use decentralized tech. Level 3, we're decentralized because we make our users free. So if you're building something, the first question to ask is, are you making your users free? So we could go through some specific examples, right? So one of them is layer 2s, DEXs, other types of applications that have sketchy properties, right? So this is a thing that's happened in the space for the last few years, and the L2 Beat crew just deserves a huge shout out for just like being amazingly on the ball for just continuing to create accountability on all of this, right? Basically, yeah, when you have an L2, like you can call whatever you want an L2, right? So, 10 years ago in Estonia, they had a thing that they described as being a blockchain. And what they basically did is like they took their digitized government records and like every day they made a hash of it. And then they published the hash on their website and I think in a couple of newspapers somewhere, right? And at the time, this was revolutionary. This is like, yay, this is an enterprise blockchain use case, right? But then the question you want to ask is, well, was there even any specific person who actually like went through that pathway and like actually benefited from the trust guarantee that this created, right? And like quite possibly the answer is not necessarily, right? And so here what we see is there's a lot of instances of layer 2s, financial projects, all kind of projects where they basically have instant backdoor buttons, or still at stage 0, or claim to be something like stage 1, but actually are not stage 1, or that have upgrade buttons where the upgrade button can happen instantly and there's no way of stopping it, where there's no exit window. And if you do these kinds of things, then theoretically, in terms of technology, you're building on-chain, but practically, in terms of properties, like it doesn't actually end up being much better than a server, right? And so if you're building something where you're not comfortable making it decentralized, then quite possibly the answer actually should just be to make it a server. Example 2, dApp interfaces, right? So this is something that we've actually seen as our over the last like half year or so, right? So basically, you can have amazing formally verified contracts. You have your smart contract that's only a few hundred lines of code. You have like 10 auditors. You have fancy auditor KOLs from 9 continents, including 2 on Mars that managed to figure out that the thing has no bugs in it. Then you have formal verification from companies on the other 5 continents to figure out that everything is safe. And then it's like all perfect, right? But the front end that everyone uses is replaceable by hacking the server, right? And so if you have a design like that, right, a design where the back end is like theoretically super awesome, but the front end is a house full of straw, then an attacker is not going to attack your reinforced steel door. They're just going to move 1 meter to the left, and they're going to attack the straw, and the wolf knocks the house down, and the pig still gets eaten. So the solution to this is basically, static HTML pages, doing versioning directly on IPFS, creating ways for users to directly access web pages through IPFS, and also more advanced solutions. So OK Contract is one that I know people have been working on, creating like more specialized and more restricted ways of doing interfaces. I know that there are other interesting projects doing things like this, whether in RISC-V or in other languages. So basically, once your smart contract is perfect, like the dApp interface just has to actually be something that we focus on, right? Example 3, governance attacks, right? So if we talk about governance and decentralization and the underlying goals of protocols being governed in a decentralized way, right? There's this kind of paradox where there's sort of the approved standardized way of doing governance, which is basically a token holding DAO, and that it makes proposals and everyone votes on the proposals. But then actually, we've seen that approach fraying more and more over time, and we've seen that approach, even if it's theoretically decentralized at the L1, it ends up structurally leading to centralization, right? And so if it structurally leads to centralization, in this case, you have things like lobby that basically turn votes into auctions, which just completely changes the underlying logic of the mechanism when you can go and buy decisions. So governance is something where you don't just need to think about the formal rules being decentralized. You need to think about whether or not it's enabling outcomes that are decentralized. Example 4, ZK identity, right? So this one is interesting. I mean, I'm sure some of you have seen this. This meme was from a post that I wrote last week on the subject, right? And basically, in this case, the argument is, well, okay, so you have zero-knowledge proofs, and you're using zero-knowledge proofs on top of an identity system, right? And if you use zero-knowledge proofs on an identity system, then, this is great, and you have privacy. And, you can prove that you have an identity without revealing which one, and these things are all amazing, right? But then the question is, well, do you really have privacy, right? And actually, there are situations where the privacy that you get from a ZK is easy to overrate, and the loss of privacy that you get from enforcing a stricter one-per-person property is actually the thing that's easy to underrate, right? And so basically, if everyone knows that each person is limited to having exactly one account, that even if anything is ZK'd by default, well, anyone can just coerce you into revealing your master key. And if they force you to reveal your master key, then they can see every single thing that you've done. Basically, a lot of the early motivation was basically ensuring that the mobile software ecosystem is as free as possible. And, it succeeded in some ways, and it also did not succeed in other ways. And I think, as as a crypto ecosystem, right? First, we don't just want to succeed. We want to be something that is worthy of succeeding, right? We want to be something where the next generation can look at it and they can say, yes, this is something that actually is built bringing openness and freedom and fair permissionless access to the masses, and it's not just yet another interest group of people who have a thing that goes up in value that are trying to make their thing go up in value more, right? I think if we lose that, then Ethereum inevitably just becomes a generational thing, and then it inevitably just passes just like a lot of other things have passed before, right? And so when we build these things, we have to put ourselves in the shoes of who we were when we first decided to join Ethereum, and we're not yet convinced that this is the ecosystem to be contributing to.
However, while Ethereum is struggling with internal pressures, Bitcoin is growing stronger due to forces outside the crypto world. That's according to Fred Thiel, CEO of Mara, one of the world's largest Bitcoin mining companies. He says the interest flooding into Bitcoin right now is massive, and he's not talking about the usual internet crowd or casual traders. He's pointing to real giants, institutions, sovereign funds, major corporations, all quietly stacking Bitcoin not for speculation, but because they trust it. Bitcoin doesn't promise apps, tokens, or smart contracts. It promises one thing: scarcity. And in a world drowning in money printing and broken trust, that one thing is suddenly priceless. No inflation, no central command, no hidden switch, just a digital asset with a fixed supply that can't be messed with. He also said his company is hedging its bets by diversifying into AI inference and energy assets, such as wind farms. Thiel is also promoting Bitcoin mining as a grid stabilizer, utilizing it during peak demand to ease the strain, as seen in Texas. But with hot weather forcing shutdowns, miners lose revenue. While Ethereum is still struggling to fix its issues, Bitcoin is quietly generating substantial revenue by simply doing nothing extra. It's not evolving fast, and that's the point. Bitcoin is proving that being simple and stable is more valuable than being complex and broken. Let's watch clips from Fred Thiel's explosive session to gain more insight.
The Bitcoin that we hold on the balance sheet is constantly marked to market, but more importantly, as Bitcoin continues to be accumulated by institutions, you mentioned it in your kind of preamble as you're talking about, BlackRock's Bitcoin ETF having garnered bigger fees than the S&P 500 fund. There's a huge amount of institutional interest in Bitcoin. There are a number of Bitcoin treasury companies springing up every day, and you're seeing an accumulation of Bitcoin, which is driving the price up. We're almost at record highs again. And as that continues to move upwards, it helps us generate considerable margins. The thing with our business, similar to the AI business, and I think you're going to find this if you look at any AI company that operates large data centers, is there's a huge CapEx investment up front in building these sites, and the profitability comes over time once the equipment has been depreciated. We depreciate our equipment over 3 years. We're able to essentially move our ASICs that have been depreciated to these low-cost marginal cost energy sites, and that drives much higher profitability and also better capital utilization. The model with Bitcoin treasury companies and the model that Michael Saylor has optimized is essentially buy Bitcoin, issue equity, and as the price and value of the Bitcoin that you have continues to go up, it drives your equity price up. And if you can raise capital at a higher price than Bitcoin, then your Bitcoin yield per share goes up, which is very attractive. The problem is what happens if Bitcoin price stays flat or starts to go down. You said his stock was up over a 5-year basis by a huge amount, which is true. But if you look from year to date at its performance compared to the Bitcoin miners, even, you're starting to see that performance is running into headwinds. In theory, a Bitcoin treasury company's price should increase by upwards of 2 times whatever Bitcoin's price is increasing on a daily basis because of the leverage that they're driving. And that's not the case anymore. I think what we're starting to see is the saturation of the Bitcoin treasury business market, because to your point, they're not in any other business. They're taking over a company with a marginally profitable business and they're turning it into an accumulator for Bitcoin. And at the end of the day, you have a bunch of people competing for capital, and that capital is going to go to the highest return, which means the lowest multiple to NAV. And over time, that multiple to NAV is eventually going to go to zero, not unlike what happened with Grayscale, where for a long period of time, the Grayscale Trust, which held Bitcoin, was trading at a discount to its NAV. And I think there's risk, especially as you layer a lot of debt on these companies. If Bitcoin goes down by any considerable amount or stagnates for any length of time, there could be challenges for them to maintain that multiple. We follow very much a capital allocation model where we look at our average weighted cost of capital, and then we look at the types of investments that we're making to see that we're ensuring that we have, are above a certain hurdle rate across a variety of places. And if you think about our business, we were basically 5 people and a few miners 4 years ago, and today we're the largest in the world at what we do. And we're also the second largest holder of Bitcoin in the world of corporate entities. And so I think we have built a very strong balance sheet. We've built the ability to execute. We're the only company of the publicly traded miners that has the geographic distribution that we have, and that has the kind of breadth of business that we have. And I think that's going to pay off very much, not just in the near term, but the long term, as Bitcoin becomes more and more of an institutional asset. Bitcoin data centers start becoming more and more integrated into energy transformation plays with data centers. The grid has a huge need for flexible baseload, which is essentially a type of compute that can turn on and turn off as needed by their grid. You guys saw with the heat bubble that happened in the Northeast, the grid was strained. Yet in Texas, they didn't have those issues. Why? Because in Texas, they have a large amount of Bitcoin mining on their grid where the grid operator can tell them, hey, shut off, I need the energy. And Bitcoin miners comply and shut off. If you had more Bitcoin mining across the grids in this country, especially the grids that are heavily loaded, you would not see the challenges that you have today, such as in PJM and other ISOs, where consumers are being impacted by increasing prices of energy because AI loads, which are not flexible, are coming online, and they're getting more and more strain on their grids. So we play a very unique role in helping balance grids and helping make grids more flexible. And I think what you're going to start seeing is an embracing and a bit of a marriage between AI data centers, Bitcoin mining, and how the two can work together to optimize grids and make sure that there's plenty of available energy for consumers. If you wanted to do some research, Duke University did a study about 4 months ago on this topic that showed that there's more than enough energy on the U.S. grid to support flexible loads if they could flex 0.25%, which is a quarter of a percent. And we flex upwards of 30-40%. So we're clearly an answer to that problem.
So what does this all mean? It means crypto is no longer heading in one direction. It's splitting. Ethereum is now undergoing a high-stakes rebuild, and everyone, from developers to investors, is aware of it. Vitalik himself has warned that if Ethereum doesn't fix its fees, improve its scaling, and finally solve decentralization without breaking the system, it risks losing everything it fought to build. Now, fake decentralization is prevalent, from layer 2s and dApps with secret admin backdoors to systems that crash completely if the development team disappears, rendering them no better than a centralized server in disguise. Then there's the illusion of safety. Even if the smart contract is rock solid, the front-end website can be hacked like paper, leaving your vault wide open through a straw wall. Governance? It's mostly theater. DAOs pretend to be democratic. Still, whales simply buy their way into power, proving that rules mean nothing without genuine decentralization. And when it comes to privacy, zero-knowledge systems and mixers like Tornado Cash appear secure. Still, a single identity leak or centralized RPC log can expose everything, proving that these aren't random bugs, but rather deep systemic failures that drain user trust every single day. That dream of an open internet, decentralized finance, and blockchain identity? It's all riding on whether Ethereum can finally deliver on its promise. But while Ethereum is rebuilding, Bitcoin is cementing itself as something else entirely. Not a tech platform, but a financial foundation. Fred Thiel says the institutional wave into Bitcoin is unlike anything he's ever seen. From banks to energy firms to government-level players, everyone is watching Bitcoin not as a bet, but as the new backbone of digital value. And here's where the worry begins. What if Ethereum fumbles the fix while Bitcoin continues to rise? What happens if the platform that was supposed to power global innovation ends up stuck in its own complexity? At the same time, Bitcoin, doing absolutely nothing new, wins by default. That's the cliff on which crypto stands. If Ethereum fails, we don't just lose a coin, we risk losing an entire layer of innovation, the one that was supposed to build the future. And if Bitcoin becomes the sole winner, it may come at the expense of genuine progress. Vitalik is pushing for evolution. Thiel is watching silent dominance. Both are right in their own way, but the clock is ticking. This is no longer about community drama or online hype. This is about execution, delivery, and survival. One platform is racing against time to evolve. The other is anchoring itself in the global economy. And the split between them? It's no longer a debate. It's real. Now, the biggest questions in crypto are no longer technical, they're existential. Thanks for watching, and don't forget to like and subscribe.